Hey everyone, it's Ryan with Stock Investing and Trading 101. Today we got something interesting. We're talking about the marijuana and the pot stocks. Today I have some very important news. If you are an investor in ACB or some of these other marijuana companies, there is something happening next week that you really need to know. And we're going to talk more about some of these Canadian pot stocks today. So I have a article from the Motley Fool talking a little bit about the pot stocks. First, I'm just going to start with this basic overview that they have, and then we're going to get into the ACB news that everybody needs to know, and also talk about a couple of other companies. So the article says, at this time last year, marijuana remained one of the hottest industries that investors could buy. Canada has recently legalized recreational pot, and the country was slated to introduce higher margin derivatives later this year, such as edibles. The U.S. was also expected to deliver substantial growth, with lawmakers in numerous states actively engaging in legalization discussions. So we had quite a few states legalize marijuana last year, which was supposed to be a catalyst for higher demand, higher profits, larger amounts of growth. Today, however, the cannabis industry is in disaster. The launch of high-margin derivatives in Canada, such as edibles, ended up being delayed, and important provinces like Ontario have struggled to create an adequate retail presence. Meanwhile, high tax rates have made it difficult for the U.S. pot stocks to compete with the black market. Pretty much, it's cheaper to buy it on the black market than it is to buy it at one of these legal dispensaries, which is obviously causing issues for some of these companies, and that's because of the high tax rate. Very little has gone right, and pot stocks have paid dearly for it, with across-the-board declines of 50 to 95%. So I'm sure a lot of you know that already. Pot stocks, they were all the talk of the town in 2019, but here we are in 2020, and these stocks have gotten nowhere. Most of them have dropped over 50%, and it's just been a disaster for anyone who's been invested in these companies. And now I know there's a lot of people out there who are still waiting for a huge spike in some of these companies. I know people think that this is going to be a booming sector in the coming years. And that might or it might not be true. It's definitely very speculative, and there's no really proof behind it because this is all new. The marijuana being introduced into the legalized sector of the states and these companies. So the article continues, with these huge drops, they have some investors searching for bargains. The reality is that a handful of pot stocks listed on the stock exchange or the NYSE have fallen so much that they have no choice but to enact a reverse split in order to avoid being booted from the exchanges. So here we get into something that is very important. I'm sure some of you have heard, in order for a stock to be listed on the stock exchange, such as the New York Stock Exchange or the NASDAQ, it has to have a $1, at least a minimum share price of $1 for, I think, a certain period of time. It can't go under $1 for more than, I think, a 60 or 90-day period. So here we get into Aurora Cannabis, which is under $1. It's in the 67 cents per share, between 60 and 70 cents per share, and it's been there for quite a while. This means that ACB needs to get their share price over $1. Otherwise, it's going to be delisted, and it will no longer be publicly traded on the market, which would be a disaster. So though it might sound like fear-mongering, it's not. Last month, ACB stock announced that it would enact a 1-to-12 reverse split on or about May 11th, which is Monday or Tuesday. Sometime this week, ACB is going to be doing a 1-to-12 reverse split, meaning for every 12 shares of ACB that you have, they will turn it into one share. So the way this is done is, for example, if ACB stock was at $1 per share, it's not, but we're going to use this as an example. So if you had 12 shares of ACB stock at $1 a piece, you would have $12 invested in ACB and you would own 12 shares. Instead, what they're going to do is turn your 12 shares into one $12 share, which will obviously get the stock price above the $1 minimum, which will take the risk of being delisted away. And that's the main point of a reverse split. But oftentimes a reverse split is taken negatively on Wall Street. So the New York Stock Exchange continued listing rules required a minimum share price of $1, which ACB hasn't been able to maintain for the last 2 months. It also doesn't help that ACB has been diluting its shareholders into oblivion, thereby weighting down its share price even more. Following the upcoming reverse split, Aurora Cannabis should be above $8 per share, which I was talking about earlier. They're splitting the price, pretty much turning 12 shares into one more expensive share. And what they're talking about with the Aurora Cannabis has been diluting its shares. So what they've been doing is selling more shares. They've been putting more shares on the market, and it's been diluting all of the other shareholders, which is causing the stock price to go down even further, which is even more of a nightmare than it already has been due to the poor performance. So there's just a lot going on with it. You have the reverse splits, you have the awful performance. I mean, these companies aren't making profits, or some of them are losing money. Most of them aren't even making money. And they're also diluting shareholders. There's just a lot going on with these stocks, and it's just kind of been a nightmare for investors. Moving on to CannaTrust, this is another marijuana company. So this is a stock that's listed on the stock exchange, and it has been under the $1 minimum. So that's also going to be a problem. They're going to have to reverse split or do something to fix that. But they actually got caught for illegally growing marijuana in 5 cultivation rooms for a period of 6 months. And last year, Canada Health suspended its cultivation and sales license. CannaTrust hasn't followed any financial statements in an entire year, with the exception of providing updates on its cash balance in sporadic news releases. So I mean, this is pretty sketchy right here. I'm not personally too familiar with CannaTrust. I'm definitely not an investor in this company, but for anybody who is currently invested in this company, I would definitely do some research as to if this is something that you are going to want to continue to keep holding in your portfolio, because they have a lot going on, and if they got their license revoked, I don't know how they're going to be able to stay in business unless they can get that license back. So it goes on. Equally worrisome, reverse splits are often viewed as a sign of weakness by Wall Street investors. Although not all reverse splits result in a company's share price going lower, it tends to happen more often than not. What they're saying is that after this reverse split, the majority of times after a reverse split, stock prices will go even lower. So that is definitely a threat if you're invested in Aurora Cannabis, which I personally am, with a very small position. So next we go into 3 more pot stocks that are going to have to do something soon. More than likely, it's going to be a reverse split. The first one we have is Hexo, HEXO. So this is a Quebec-based marijuana producer, which has been trading for less than $1 for pretty much the entire last 2 months. And it's they're saying it's weird that Aurora Cannabis has done the reverse split before Hexo, because this is actually even worse performing. So like most Canadian producers, Hexo is in a world of hurt. The company wound up expanding production far more than it needed, and now it's scrambling to raise capital and paring down its operations to match prevailing market conditions. Pretty much they expanded, spending a lot of money, and it didn't pay off. They shed 200 jobs last year, so they're laying off employees. They're wasting money on expansions that aren't needed, and it has idled about a third of its peak production capacity. The real killer was the admission that its New Strike Brands deal was unnecessary, so they made a deal with the New Strike Brands, and it's apparently not that great of a deal, and so that's also weighing in. So these companies just have bad news after bad news. They're making bad deals. Some of them are, breaking the law and getting their license revoked, and the majority of them are, at risk of being delisted, otherwise being forced to reverse split. And on top of that, most of them are also, or many of them, are diluting their shares. So it's just a bad situation. So even with its leaner operation, because they've had to write down, I believe, 140 million Canadian dollars, as well as 111 million Canadian dollar goodwill write down. So they're writing down their business assets, effectively making their company, worth $140 million less. So even with this smaller operation that Hexo is running, it's far from being out of the woods. Over the past couple of months, it has been diluting shareholders even more by selling more common stock to raise capital, and they've been selling it at a price that's cheaper than the previous day's closing price. So if you can imagine Hexo at 50 cents per share, and now the company comes out and they say, okay, we're going to sell 10 million shares at 40 cents per share when the market value is 50 cents per share. What do you think is going to happen? Obviously, people aren't going to be wanting to buy this stock for 50 cents a share if the company is selling it for 40 cents a share. So this isn't a company that's just trying to stay listed on the stock exchange. Some of these companies, they're doing every single thing they have to do to survive. The thing is, if they weren't diluting their shares, a lot of these companies would already be out of business or, very close to completely being out of business, bankrupt, and delisted. So they don't really have a lot of options in many of these cases. Lastly, we have Organogram Holdings. This is a New Brunswick company. It ended on May 5th at $1.49 per share, very close to its 52-week low. So it's above its $1 minimum. But this, they say that this is possibly one of the only Canadian companies worth owning. I'm not going to get too deep into that because I never really trust these articles. I would never, ever invest in something because a Motley Fool article says it's worth it, or because I say it, or because somebody on CNBC says it. I like to do my own research, make my own decisions, and do it that way. I think that's the best way. Everyone has their own strategy. They have their own vision. And invest their own way. So what works for me might not work for you. What works for the Motley Fool might not work for me. And it just, everyone has their own way of doing things. So pretty much they're talking about that this company might be something to look at. I'm not too fond of it, so I'm just going to kind of pass by that. Lastly, we have Afria. This is a little bit more popular of a company. I'm sure many people have heard of Afria, ticker APHA. So this was going for $3.60 per share on May 5th. So it's well above the $1 minimum, and it traded at below $2 just a month or two ago. Many companies, Wall Street banks, won't invest in companies that are less than $5 per share, which is a problem. If institutional investors aren't going to be buying your company, it leaves it up to retail investors, which it's just not something that you want to be a part of. One reason the company may be so hesitant in doing a reverse split is that its operating reports have been coming in better than expected. So its cannabis revenue soared 65% on a quarterly basis during the third quarter, with the total sales nearly doubling and the company reporting a profit of 5.7 million Canadian dollars net income. Such results would not suggest that Afria is operating from a position of weakness. So this is actually possibly a strong company based on just the last quarter. It doesn't have a very long history of this good performance. But this is a good sign for this company. Hexo and Aurora are really struggling. This company is actually doing better in the past, quarter or a few months. However, the bulk of Aphria's revenues continue to be derived from its pharmaceutical subsidiary, and distribution revenue can be lumpy at times, and it's relatively low margin. We haven't seen Aphria's cannabis operations consistently deliver an operating profit without the assistance of one-time benefits or fair value adjustments. Until that happens, there may be a real possibility that they need to do a reverse split. Pretty much what they're saying is that the company has been performing somewhat well as of lately. However, it's not really due to the marijuana part of their company. It's due to the pharmaceutical parts of their company. So that's the video, guys. I think the main thing here is that ACB is doing a 12-to-1 reverse split starting next week. I know I have 100 shares of ACB. I sell covered calls to lower my cost basis. So my 100 shares are going to turn into like 20 shares or less, which is really going to suck. I can't sell covered calls with less than 100 shares, and it's just going to make it very difficult to make up my loss and sell this for a profit. So after this reverse split happens, I'm not exactly sure if I'm going to sell and lock in my losses or to continue to hold. I may continue to hold just because it doesn't have much further to go down. I only have like $500 or something invested in this company, so it's not the biggest deal. But at the same time, this stock has been doing nothing for me besides going down, being diluted, and now it's doing a reverse split. It's just one thing after another, and it's just not something that I enjoy being a part of. So that's the video, guys. I know a lot of people are very interested in these marijuana companies and interested in investing in companies like this, but you have to know the risks while you're investing, and these are some big risks. I mean, these companies just aren't strong, fundamentally, companies. So thanks for checking out my video, guys. If you haven't already subscribed to my channel, please do that. It'd be greatly appreciated. Don't forget to like the video, and we'll talk to you guys soon.